Hi friends, today you're going to learn something really very powerful in investing, and it's going to really change your life if this is the first time you are hearing this strategy. Okay, as always, with knowledge you really gain the unfair advantage in anything you do. So this is regarding investment, and this investment, this thing I'm teaching you, right? There are people that pay a few $1,000s for this knowledge. I used to be a investment trainer, and I teach people a lot of different strategies, and this is one of the most powerful strategy that's out there. If you go to like commodity full options, that kind of stuff, there are courses like packages down there, and something like that will sell like $3,000-4,000. Anyway, the money aside, what I really want to do is really benefit you guys a lot. You don't need to like understand deep understanding because it actually goes in practice, but you just need to understand the theory behind it, and hopefully you can actually apply this in your trades that you do for whatever stocks that is going to be out there. All right, so without further ado, let's start. For this particular video, I'll take Tesla as an example because I'm highly invested in Tesla and I love their business. So I'm just going to use this company for example, but there are many other companies you can apply this strategy to. Okay, so firstly, let's look at the Tesla stock itself. Okay, as of doing this video, Tesla stock price is at $480. By the time I release this video after lots of editing, I got this feeling that Tesla will fly to $600, which will take like a few days. I'm not too sure. So it may fly to 600, it may drop to $400. I'm not too sure, but I got this gut feeling, right? Although I I did say that it will actually like peak at 500, but Tesla is just doing stupid moves right now, and the market is very irrational, or like rushing in I call that fear, FOMO, like fear of missing out. So probably if it goes up, it may actually shoot past like almost nearing like 600, 550, 600. I'm not really sure. Okay, but as of now, Tesla stock price as of doing this video is $480. And imagine you have the power to do this. You have the power to buy the stock at lower than $480 now. Okay, so this strategy applies this. Firstly, number one, your target price should be more than the current price. So that means to say, let's say you have a vision that Tesla may be worth $1,000 in 2 years, or for me, I have a vision that Tesla will be worth $3,000 to $4,000 in 3 to 4 years. Imagine you have the power to buy Tesla at a far better price than $480 now. Immediately, you win most of the people out there already. Okay, so you must understand that your target price must be higher than the current price. And if you manage to buy below this, actually immediately you win already. Okay, that is a fact. Okay, so now the thing we're going to use is this thing called an options contract. So an options contract is basically is a bit technical. You can Google this, but I just write off say this, but you don't need to memorize it. Okay, you just don't need. This is just a technical term. So an option contract, one contract equals to 100 stocks. So let's say, for example, let's say like there's one company I'm looking is at JD Jingdong. It's like Amazon of China. So if the stock price is at $30, one contract, the technical definition of this contract should be $30 times 100, so which is $3,000. If you're talking about Tesla, one contract is 100 stocks, so 480 times 100, which is $48,000. Okay, so one contract equals to 100 stocks, and like every contract out there, there should be this thing called the agreed price. So you cannot like agree on no price at all. Then there's no contract. Even your current health insurance, there's an agreed payout amount if something happens to you. So there must be an agreed price. And of course, with every contract, there always an expiry. There is no such thing as a till you die contract. Even okay, other than a marriage certificate, which you can actually cancel it. Okay, anyway, other than most contracts, they have a definite timeline where it will expire. Okay, like your car insurance probably take a year. Health insurance, you need to renew every year. Okay, so this strategy is pretty simple. Okay, this thing is we're going to do this thing called a sell put at the money. I'm going to explain this further later, but just understand this. We're going to sell at the money. Okay, this is a non-leverage play. must remember this. Let's say, for example, you want to do Tesla and you want to do like one contract. So you must know how much money you must have in your account. Okay, because remember, this is a non-leverage play. So let's say, for example, you need to do Tesla now with this strategy, you got to have, yes, you need to have 40 $48,000 inside your account, which is for 480 times 100. Okay, remember this. The function of sell put means this: once you initiate this move in the options world, what happens is that you are telling the options market this: I will agree to buy the stock at the agreed price. Okay, and the agreement ends at expiry. So for example, if I tell you to sell put at the money for Tesla, you will initiate a sell put $480. That means that you agree to buy the stock at $480 at the end of expiry. Understand this? I repeat again. Ask you to, if you initiate a sell put at the money for Tesla now, as of doing this video, which Tesla is $480 now, this is what you're trying to tell the options market. You agree to buy the stock at $480, okay, and the expiry ends at a particular date which you choose. So to illustrate this strategy, imagine this green shirt guy is us, okay, it's me. Okay, I'm also wearing green, he's wearing green. So now, so how does it look like? See, this contract will look like this. I agree to buy 100 stocks of Tesla shares at $480. And there's a length to this expiry, which is January 2021. And the options premium out there is $85. Okay, why $85? Is because imagine you are agreeing to take the risk to buy the stock at $480. That is your risk. This is my risk. Okay, we are taking this risk of buying the stock at $480. So because we agreed to this risk, we shouldn't do it for free. So people will pay us to take up this risk. So how much they pay us? $85 per stock. So for every contract that goes out is actually $85 times 100 stock, which is 8,500. So the moment you agree this on the options contract, what happens is the person will pay you money to take on this risk. Very simple. So how does it look like in your bank account? So what happens is that currently, remember, we are not leveraging because one contract is 100 stocks. So you must have this money ready in your account to take on this risk at any time, whatever this thing happens. But because you take on this risk, so what happens is that you have $48,000 in your account now, and you decided to do this particular position. What happens is automatically $8,000, $8,500 will fly into your account. And what becomes the total of it is 48,000 plus 8,500. This is literally free money in your account. Free. Okay. You just take on the risk, you get this free money. It is unbelievably like stupid. Okay.
This is how it's going to be done on the brokerage platform. All brokerage will look roughly the same. So this is just the main page here. We got to go to trade tab, and in trade tab you need to key in your ticker symbol. So in this case, since we are talking about Tesla, we're going to show Tesla. So over here, up here is where you actually buy sell stocks. I don't think I need to teach you how to buy sell stocks. In this case, we are actually doing options. So there is an option chain below here, and we click the option chain. So as I taught you guys that we are going to sell put, and we are going to sell, in this case, a 1 year put. So if you scroll down, this is roughly a 1 year, so it's 368 days, roughly there. All right, and over here is where I will show you to sell at the money put. If you look at the arrow bar just below the arrow, do you see a small little sell word there? So this particular action is called a sell. So you could sell at many different we call that agreed price or strike prices. See, you can actually do a 420, you can do a 550, or you can do a 480. I do not want to go in the discussion on why it's not here, why it's not here, but I am doing over here. So I'm just going to outright say that the reason why I choose this is because at the money puts has the highest time decay value, which we are kind of going after time decay. All right. So over here at 480, this strike price here, this agreed price is the closest price to the current stock price where it's trading at. So just by clicking 480 sell, you click over here, immediately you will come out to a screen over here and it should tell you like -1 contract because they're selling, so it's a -1. And once you affirm the price over here, you have to click like confirm and send. So if you're using interactive brokers, Robinhood, or other platform that does options, all option chains look exactly the same. Okay, I'm going to go back a little bit just in case. See, there are calls and puts. Do you see this? Calls and puts. So you got to select put option. You are 1 year away. So this is 368 days, which is roughly a year. And you're going to sell this price here, the strike price over here, closest to the underlying price here. And in this case, it's going to be $84.10. So upon clicking this again, you come out to a screen -1 because it's a sell order. You click confirm and send. So on this screen over here, you will see that you will receive $8,400 for every contract you sell. So all you need to know is this: you will receive $8,400 in your account instantly when you do this order, and this order is actually filled in the open market.
Let's now take a look at the two scenarios that will happen. So there's only two possible scenarios. The stock by January 2021 will be above $480 or below it. So moving 1 year forward, so imagine you move to the future, okay, and the stock drops below $480. So what you're going to do is you're going to take $48,000 from your account, which you are supposed to use already to buy the shares. So this, instead of buying the shares, this money will just floating in your account, because remember, this is a non-leverage play. So what happens is that $48,000 will be taken from your account to buy the shares. That's it. So you own the shares at $480 at the end of January 2021. But remember one thing, you still have the $8,500 in your account. So that money is already in your account. Nobody can take it away. Think about it this way. When you buy your health insurance, do you think you can take back your health insurance money from the insurance company? No, it's not. It's theirs forever, okay? So what happens 1 year forward and the stock is above $480? Nothing happens to your account. What happens is that you already received the $8,500, remember? So that is like permanently yours, and your $48,000 in your account still stays there as free cash. So the cash has not been touched. So in total, you still have $48,000 plus the $8,500 that you received earlier from the year, which you already had in your account, which you can do other things with the money. It's up to you. It's your money. So I would like to summarize this particular strategy over here. Your worst case scenario is your buy price is 395. Why is your worst case scenario 395? Because remember, you received the 8,500. So you actually take the $480 minus away the $85 that you receive. So because you already received the money, we take that as your maximum like break-even price. So your worst case scenario, your break-even price is 395. You are already buying lower than the market at the point of time. And the best case scenario, you walk away with $8,500. This is stupid. This is like win-win for you. Okay. So now I just want to quickly cover an advanced FAQ, because there will be some people who do options who is watching my videos, and I've been doing options for like 5-6 years, that is professionally. And I want to address a few like small questions that may come up in my, or if I didn't address in the advanced FAQ, just please leave them in the comments below. This if you don't understand, if this is your first time listening to options, right? If you don't understand all these terms here, it is okay. You have not lost out in anything, but I just need to say it over here for the advanced people. Okay, why not in the money? Because in the money, basically we are actually receiving a lot of intrinsic value. So when you receive intrinsic value, you do not really receive the maximum time decay. That is why I do at the money. It has the most time decay. And why not OTM? Again, you won't be receiving intrinsic, but you'll be receiving lesser extrinsic. So at the money, because what we're after now is the maximum time decay possible for the contract. So I choose at the money. Okay, again, why not monthly options? Then some, because you can choose many different, you can choose monthly, you can choose weekly, you can choose yearly. Why not monthly? Because I want this to be a very passive movement. You can choose 1 month, it's really up to you, but 1 month the options premiums are like around $20. Is lesser, but the thing is, yes, I know you can do it every month, but you cannot predict the price movement of Tesla that goes up and down, or any stocks. It will just go up and down, up and down, up and down. So from my experience is, the less you touch your account, the better it is for your account. Those people with like 5 years of investing in the stock market, you will understand what I'm trying to say. Okay, I cannot like explain everything in this one video, because it's going to take like one whole day to do it. Okay, next thing, why not spreads? Because a lot of people that does option spreads, they look at ROI, maximum risk, they calculate risk to reward. Again, we are not trading this. We are long-term investors. We are stubborn long-term investors. We are doing this position, awaiting for assignment if it comes to us. So this is as good as a stock play. I'm not doing like ROI, that kind of play. No, I'm not doing none of those. This is a different topic. Okay. Okay. Why don't you leverage and why don't you hedge it? That kind of thing. Again, I don't believe in leveraging, because if you leverage a position like that, and if the stock goes down, margin call comes in very quickly. So leverage is not the play most investors can take it. Okay, that leverage is actually the most common way most people go wipe out their account. So again, next one is, why don't I hedge? I can hedge the position by buying puts, but the thing is, again, advanced people, you understand that by buying puts, time decay comes in and you are paying for time decay. So that is not something we want to do. So in this case, I'm selling puts to receive the time decay to my advantage. So anyway, again, I just want to summarize very quickly for all of you. This particular strategy is quite stupid. Okay, it's quite stupidly unfair. Your worst case scenario is you buy the stock at unbelievably lower price than the market already, and the best case you walk away with money. Okay, anyway guys, I hope you like this video. Do help give me a like, and you have any problems, any questions, just leave them in the comments below. As usual, I will answer to all the comments down there. Right, thank you so much, and invest safe.